He's staying bullish, finding opportunity, he says, in some of the sectors hardest hit by the recent spike in yields. Joining me back at Post 9, John Mowrey of NFJ Investments. Welcome back.
Good to see you, Scott.
All right, so it's been a rough month, obviously, and you're still bullish.
I'm still bullish.
How?
Well,
yields are up, stocks are down.
I know there's a lot of negativity. If you remember a year ago, it was also very negative around this time, and it happened to be raining outside the last time I was on, I think in October, and it was very gloomy. What I would say is that the rise in interest rates has really created some big dislocations. And if you look at utilities, if you look at REITs, and if you look at banks, all those areas are tied to rates, and they're all big time on sale. The Russell 2000 value, Scott, I heard you mention earlier on the set that the small cap names are looking more attractive, and I'll give you an interesting statistic. Did you know there's only been 2 times in history where the NASDAQ was up 30% or more in the first 3 quarters of the year, and the RUJ was negative? Those 2 periods were 2000 and 2020. In both those periods, over the next 24 months, significant outperformance in the small arena relative to the NASDAQ. So I think the NASDAQ looks less interesting here relative to some of these other areas.
What about what Tepper told me a little while ago, okay? To him, it's just not that complicated. It's no more QE. It's all about QT. Rates are elevated. The multiples might be too rich in that environment, especially if earnings don't live up to the hype of where they're expected to be. That's a very, very easy to understand thought.
The multiples are very cheap with the banks. I'll sit on the banks for a second. So, you know, every sector is negative this quarter except for energy, right? But I will tell you that the banks actually are positive. They're beating the S&P this quarter by 400 basis points. What's interesting is that has coincided with the yield curve starting to unwind. So that inversion that we've been looking at, that peaked in the second quarter, at the end of the quarter. That is beginning to unwind. I think financials are an area that people are completely missing out on. They're worried about the banks. They're worried about real estate. They're worried about credit. And if you look at the valuation, Scott, you're getting dislocations not seen since 08 and 09. So it's really interesting for investors that don't want to be overpaying for a lot of the growth names. And I think also relative to fixed income, these yields are very attractive and growing.
So you're going to put all your bullish bets on the banks? I mean, that's not going to get many people on your side of the boat.
Well,
necessarily. So that's where you're stating your bull case?
Well, I mean, if you think about REITs, utilities, financials, that's 50%, okay, of the opportunity set in the value arena. So it's a significant portion. I would argue that industrials look pretty rich here. There are pockets of consumer discretionary that looks very attractive. Also materials, Scott. Some of the fertilizer companies have been trashed. There are opportunities outside in materials. There are opportunities in discretionary as well. But those areas look much more interesting than tech.
Why would I go for REITs or utilities when I'm already getting yield? What am I doing in those things? Or I'm doing what Tepper did. I've got 6% on a CD.
This is why the opportunity exists, because the prevailing wisdom right now is own technology, because that's going to give you the growth, and then own fixed income.
Because you have the best balance sheets, right? You don't need to access debt markets. You got the balance sheets the best. You're sitting on mountains of cash.
Correct, but you're paying a lot in terms of a multiple. I mean, why were people selling tech a year ago? They were selling it because of interest rates. They've forgotten this. Now they're owning technology. It's up 35% off of the lows.
Well, because of AI.
Well, AI, yes, but did rates not matter? I mean, that's almost like a fairy tale now. It's like, is that really the reason that people were selling these? I mean, what I would argue is that the reason you just stated, because of fixed income, that's creating the opportunity. Utilities are underperforming the S&P by 27% year to date. These are massive.
Well, they should be, because rates have gone up a lot.
And therein lies the opportunity. The reason utilities are underperforming in some of these defensive areas like banks and REITs, there's 2 reasons. The first is people were overpaying for defense. A year ago, I sat on this desk and I was very bullish. I didn't like utilities. I didn't like REITs. I didn't like a lot of the defensive areas. They were priced very richly. Okay, we joked about Hershey's chocolate chips and semi-chips, right? Now, those areas are being dumped because people are chasing performance. They're chasing the under-allocation of tech. And every reason you just stated is why these are big time on sale.
Earnings. You are assuming that they're going to live up to the so-called hype, that, you know, we get back to growth here in the fourth quarter.
Which groups?
And then, you know what I mean, overall earnings projections for earnings growth are expected to go positive.
Yes.
And then as you get into the early part of 24, they're supposed to be even better than that.
Yes.
So
yes.
as a full group.
Well, so again, I'm going to be a little bit choosy here. I'm not going to just broad brush everything. We're looking for specific areas we want to target. If you look at REITs, for example, many of these REITs, like in the multifamily space, like Mid-America Properties, they're actually raising their guidance, Scott. They are growing their FFO. Home builders are really expensive, and the multifamily REITs are very cheap. The banks, I will tell you, we do need to see positive revisions out of that. It's a very tough environment for banks with an inverted yield curve, but that's when you want to step in, I would argue. In 2000...
Ahead of a possible recession?
Well, I think the recession's priced because they're underperforming by so much.
You think a recession's priced?
In the banks. In the banks. If you look at the valuations, it is back to March of 20 and March of 08. So
you don't think soft landing's priced?
I think that's an interesting question. I'm not really sure. I mean, is it a soft landing for the banks? I mean, they've been blasted. Is it a soft landing for the bond proxies? They've been blasted. Is it a soft landing for FMC, fertilizer company, down 50% year to date? It's not soft for a lot of these companies out there below the surface. We're seeing very interesting dislocation, Scott. I think everyone's focused on this top group. And let's not forget the Magnificent Seven were the measly seven not that long ago. NVIDIA, one of the best companies in the world, was down 65% last year. Now everyone can't get enough of it.